Solar stocks, look at these. They are all in the green right now, and by a wide margin here. I mean, you've got Sunworks up 13%. Nice moves for Sunrun, Enphase Energy, SunPower, Sonovo Energy. These solar companies are angling for less expensive solar panel imports, so they are cheering at this hour after President Joe Biden declared a 2-year tariff exemption on solar panel equipment and materials from Southeast Asia. And in addition, he invoked the Defense Production Act to promote domestic solar manufacturing. The tariff exemption applies to panels from Cambodia, Malaysia, Thailand, and Vietnam. The move comes as the administration and consumers watch helplessly as oil and natural gas prices burn higher. Look at natural gas right now, 10% higher at this moment. Now, we are in the aftermarket, but a gain of 10%. We're looking at $9.38 per million British thermal units. In the regular session, natural gas hit a 13-year high as temperatures heat up across the United States, increasing demand for ice-cold air conditioning. 1 year ago, just to put this in perspective, nat gas stood at $3.07. So let's bring in Richard Swann. He knows. He's S&P Global Commodity Insights head of refined products. Richard, we are seeing a tiny retreat in crude and gasoline prices today. That's sort of in the wake of this announcement and some other issues. But give us your near-term projection of where nat gas, crude, and gasoline go.
Hi, Liz. Thanks so much for having me on. Let's start with oil, right? It's steamy, it's very stressed, this market, and it's jumpy. You've got a classic, really, supply versus demand battle going on. On the demand side, it's the recovery story. We know this. And coming out of the pandemic, we're driving more, we're flying more, consumption's going up. So where's the supply going to come from? Well, you've got the US and other countries are releasing emergency stockpiles. You've got OPEC and OPEC Plus, the countries that coordinate their policy with OPEC. They're putting more oil on the market. But the big wild card here and the big dark cloud hanging over that supply-demand picture is Russia. There are huge doubts around Russia's role in the global oil market because of the sanctions we've seen, essentially. Russia's a vital supplier for both oil and gas to the global market.
Yeah, I get that. And we know that Russia is the plus of OPEC Plus. And I don't know how much power they have left in OPEC. You tell me. I mean, are they that big of a power as they were, I want to say, about a year ago when they were able to really sway OPEC?
Well, they're still a really big producer of crude oil, refined products they export to Europe, and natural gas, hugely vital. The OPEC political thing is actually a bit complicated to read. OPEC is actually very grateful to Russia for coordinating its output. They're trying to keep Russia in the fold. Russia's ability to actually take part in the OPEC output agreements is pretty limited right now. If you look at OPEC last week, they announced increased supplies. Where's that going to come from? That's not going to come from Russia. S&P Global Commodity Insights, the analytics part of my company, we expect Russian supply actually to fall by about 2 million barrels a day between now and the end of the year. So the extra OPEC supply, not from Russia. That's going to be from Saudi Arabia.
I have to say, you know, when you look at RBOB gasoline, that is tough to see, but that's a wholesale price, $4.20. We are looking at new records for retail gasoline. Everything seems to be rising. I mean, when does this fever break?
Well, our forecast, again, from S&P Global Commodity Insights is that the benchmark prices, if you like, for gasoline, they could rise slightly over the next month or two as we go into the peak demand season. They should fall back to around $3 a gallon or so on the Gulf Coast. Here I am in Houston by the end of the year. So down a bit, still relatively high price, but some, if you like, alleviation is on the horizon.
Yeah, the relief there. But we're already seeing very odd sort of unintended consequences. Lululemon announced it's raising prices because something like 75% of its products need crude oil, petroleum, to be manufactured. We're talking about nylon and Lycra. So now they're saying they have to raise prices. This surprises some people.
Yeah, I think oil has these hidden tentacles people aren't always aware of. They see the headmark price of crude, but you don't realize if oil goes up, everything goes up. So this is about feedstock prices to make nylon, for sure, through the petrochemical industry, most of which is based around oil. But think about pretty much any consumer good, Liz, you might buy. It's going to be trucked around the country. That truck's burning diesel. The cost of diesel is baked into everything we buy.
Yeah, I get that, but I think a lot of people might be surprised to know that petroleum is directly in their Lululemon leggings. Just interesting. And you're right, the tentacles are very long. Richard, thank you, and we will wait for that fever, the price fever, to break. Good to see you.